Hey everyone, Couch Investor back to our video for today. So in today's video, we're going to talk about Sea Limited. They reported earnings and surprised us all. Huge beat when it comes to earnings per share. They actually turned a profit. Surprise, surprise. And a big beat on revenue as well. Now at the time of making this video, the stock is up around 10% or so. Now when it comes to the profitability of the business, of course, we know, just like with other companies that suddenly reported a profitable quarter, there is some accounting magic happening there. But overall, yes, the cost cuts are happening. Now, what happens with growth? Because usually when you cut costs a lot, this means that you will be growing much slower. So what's going on with that? We're going to have a look at all of that in this video. But first, I want to touch on a comment by the CEO. So we're starting 2023 on a much stronger footing. Our decisive pivot to focus on efficiency and profitability since late last year is already driving meaningful bottom line improvements. We delivered positive total net income in fourth quarter, demonstrating the strength and resilience of our underlying business model and the execution capabilities of our teams. As we continue to transition and maintain our focus on sustainable growth, our approach is to do less but do it better as we serve our users across our digital ecosystem. Now, I did continue to talk about obviously the macro uncertainty, and well, given the recent strong pivot, they are closely monitoring the market environment and they will continue to adjust the pace and fine-tune the operations accordingly. While there may be near-term fluctuations in their performance, they remain highly confident in the long-term growth potential of their market and fully focused on capturing this opportunity, which to me translates in we are being a bit more careful right now, so don't expect hyper growth anytime soon. So we're going to have a look at the presentation, look at all the numbers as well. If you're interested in all of that, hit that thumbs up button, subscribe if you have not, would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couch investor. If you missed yesterday's videos about Amazon's amazing business, go check that out. So we're starting off with total GAAP revenue. Of course, this is e-commerce. Garena or digital entertainment is the dark blue, and then light blue is SeaMoney. Now I believe quarter over quarter they also grew, so that's fine. Year over year they grew 7%. Now when it comes for the full year, overall it all grew 25%, so still some nice growth there. Now when it comes to adjusted EBITDA, you can already see a huge improvements here across all segments, not just the digital entertainment side, but obviously that has taken a huge hit, but overall most, if not all, these segments here are now positive. Now, they did say that total adjusted EBITDA for Q4 was positively impacted by approximately $130 million of accrual reversal. And then for the full year, you can maybe get a better picture. So, of course, again, digital entertainment side, Garena, Free Fire, took a huge hit this year. Now, the rest of the business on a full year basis is still pretty much negative. Then, just because they reported obviously one positive quarter of net income does not mean that they're not burning cash. They are still continuing on burning their cash. Still $6.9 billion there. They say here, excluding cash consideration used to repurchase their outstanding convertible bonds, with a gain, cash equivalents, and short-term investment would have increased by $209.8 million from Q3. Well, would have, could have. Now, when it comes to e-commerce, so we've got obviously our two slides here. GAAP marketplace revenue, year over year growth 44%, very strong there. Adjusted EBITDA, here again the Asian market is pushing that business into the positive territory. So they say here adjusted EBITDA for Q4 was positively impacted by approximately $80 million of accrual reversal. But when we look at gross orders, so that's down 12% year over year, and quarter over quarter we went from 2 billion to 1.7 billion, so not really the trend that you want to see. When it comes to GMV, that's down 1% year over year, or it could have been up 8% year over year on an FX neutral basis. And now, what was once the, well, strongest part of the business by far, digital entertainment, so Garena, you can clearly see here bookings continues to go down. The trend does not stop. It's down 18% quarter over quarter. Quarterly active users are down 15% quarter over quarter, and then quarterly paying user ratio is just down 0.1%. But at least we are seeing here maybe a base forming at around 9%. So let's see what happens. But overall, these two here, bookings and quarterly active users, you would like to see 2-3 quarters in a row where the bleeding stops, which again is not the case. And then the fastest growing business segment, which is obviously C-Money, so digital financial services. Revenue here grew 92% year over year to $380 million. So they say here at the end of the quarter, total loans receivable was $2.1 billion, net of allowance for credit losses of $238.8 million. Now, they do say that non-performing loans past due by more than 90 days as a percentage of their total gross loans receivable declined from less than 4% in Q3 to less than 2%. This was mainly due to the shortening of loan write-off period in a certain market from 180 days to 120 days in Q4, based on their assessment of historical credit losses. Without this change in write-off period, the ratio would have been about 5%. So again, some things are going their way, other things aren't. And now, of course, profitability has improved this quarter. So overall, yes, gross profit is up by a lot, 29% year over year. For the full year, we're up 33% to $5.2 billion. And here you can already see how they reached those numbers. Sales and marketing expenses down significantly. R&D expenses are down as well. G&A is up. Provision for credit losses is up as well, as we've seen before, but overall cost of revenue is down around $200 million. And so you reach a point where, well, they can report net income of $422.8 million. Overall, for the year, still burning $1.7 billion in losses, but they do say for this quarter. So total net income for Q4 was negatively impacted by $177.7 million impairment of goodwill related to certain historical investments for the digital entertainment business, and positively impacted by close to $200 million net gain on debt extinguishment and approximately $130 million in reversal of previous accruals for certain expenses, as we've seen in previous slides. So of course, let's take the first two, so goodwill, and then the next number here. So you're still at $20 million of a positive impact. Add another 130, you're at 150. So if you remove 150 from the net income, you're still here in positive territory. If you want to remove those one-time thing that really doesn't show you 100% how the business is profitable or how it really is operating. And if you want to have a look at the full breakdown of how exactly did they reach $422 million of net income, where here it is. And now, of course, those things here, right? Non-operating loss income. So in this case, it's not a loss, but if we scroll down, they give us some explanations as to how they reached this positive number. So they recorded a net non-operating income of $35 million in this quarter as compared to a non-operating loss of $71 million in the same quarter last year. Now they do say here that the non-operating income in the fourth quarter was mainly due to a close to $200 million net gain of what we saw before. So of course, if you remove that, it's still pretty much negative. And of course, the same could be said here about income tax credit or expenses, and that's also one of the reasons why you reached that $422.8 million of net income in this quarter. But overall, of course, we can continue to dissect those numbers, etc. I mean, we can go here, assets, current asset, cash and cash equivalents. They basically lost here $3 billion worth of it. So yes, the business is still burning cash on a full year basis, but maybe these past 2 quarters have shown us that they can become a bit more profitable while still experiencing some growth. And I think that's exactly what the market wanted to hear and maybe see as well. Of course, when it comes to digital entertainment, this segment was extremely strong and profitable for them. Right now, it's still having that negative momentum. Will we see growth reaccelerate maybe in the back half of the year? Remains to be seen. Right now, it's again a one-time good quarter, as we've seen with other companies. I'll throw Palantir in there as well, right? Magically appearing with a so-called profitable quarter. But to me, it's more like, show me what you've got. Show me that you continue to do so in the next coming quarter. Of course, do share your thoughts down in the comments below. What do you think about this quarter? What are your expectations? And do you still hold C Limited in your portfolio? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.